What's up, everybody? Welcome to Heresy Financial. My name is Joseph Brown, and today I'd like to discuss bonds with you guys and just go over what the outlook looks like for the bond market right now and the dangers that lie in bonds due to limited upside and huge potential downside, especially with the shocks that could start ripping through the credit markets very soon here. Let's dive in. All right, so number one, please remember I'm not an investment advisor, so do not take this as individual investment advice. It's meant for education purposes only. Here's how bonds work. Bonds have two components to them. Bonds have the price of the bond and the yield of the bond. Similar to how a lot of stocks have the price per share of the stock and a dividend that they pay, which is also called a dividend yield. A bond is debt. So when you buy a bond, you are loaning somebody money. When you buy a treasury, you are loaning money to the government. When you buy a muni bond, you are loaning money to a city government. When you buy a corporate bond, you are loaning money to a company. And if it's a junk bond, it's probably a junk company. Now, when you loan money to somebody, they pay you an interest rate on top of the principal back. If I loan company A $100 and they pay me $100 back plus an interest rate of 1%, they're going to pay me back $100. They're going to pay me back $101 at maturity. Now, this is simplified. I understand that sometimes the interest payments are broken up at monthly, semi-annually, quarterly, whatever it is. I'm just explaining the mechanics of how bonds work, just in case you're not aware, so that you can understand why bonds are such a bad investment right now. Let's say I've loaned a company $100. They're going to pay me back that $100 plus whatever the interest rate is along the way. During the time that I have that loan outstanding to them, if interest rates drop, the price of my bond will actually go up. This is because my bond, the debt that I own, is actually worth more when you consider the interest rate on my loan that it's paying me is more than any new debt that's being issued right now. And so I can sell my debt at a premium. Now, this process repeats itself over and over as interest rates drop around the system. The prices of bonds go up. That means at the same time, interest rates are going down. So these two things are always going to be inverse of each other. So when the Fed drops interest rates, that pushes the price of bonds up. If more money goes into bonds just from investors piling their money into bonds, that also drives interest rates down. Now, the opposite is true as well. If interest rates spike, let's say the Fed actually raises interest rates, that's going to drop the price of bonds because now those bonds are paying a higher interest rate. And so the existing bonds, their prices drop to meet market forces. At the same time, if investors feel they'd rather invest in stocks, they start selling bonds off. That's going to push the prices of bonds down, which pushes the interest rate that those bonds are paying higher. It's always a teeter-totter between the price of bonds and the interest rate that they're paying. If that doesn't click with you, think of a stock. A stock, let's say it's $100 per share and it pays a $1 dividend. Well, that $1 dividend per year, that's going to be a 1% dividend. If that stock then rallies to $110 per share, it's no longer a 1% dividend. That's a 0.9% dividend. And so the price and the yield are going to be inversely correlated. If the price of the bond goes up, that's the interest rate going down. They're in lockstep with each other. So right now, if you buy a bond for, it's a 1%, pays 1%, you pay $100 for it, it's going to give you $100 back and $1, so $101. If interest rates drop or more money piles into bonds, it'll drive the price of your bond up. You could sell it for $101. Well, that means the person that you're selling it to is paying you $101 for that bond, but when that bond matures, the issuer is paying them back $100 for the principal plus 1% interest, $1. So their net interest, they paid $101 for it. At the end, they're getting $101. their net interest rate is zero. What happens if more money piles into bonds and drives the price of bonds up even higher? That means, let's say that person sells that bond for $102. What happens when that bond matures? You guessed it, they get paid back $100 plus 1% interest, which is $101. They all of a sudden have a negative interest rate on that bond. They paid $102 for something, and when it gets returned to them, they get $101 back. Now, negative interest rates would not naturally exist in the free markets. The only way they exist is by central banks pushing down and artificially holding down interest rates. If the free markets ever did produce something that had a negative interest rate, it would be corrected very quickly. As soon as it goes negative, it's going to correct itself and people are going to sell their bonds off to take advantage of those high prices on the bonds, and it would push it back down to a positive interest rate. The Federal Reserve has also been very clear that they are not going to push interest rates negative. They can't do that. As the global reserve currency, it would wreak havoc. It would expose just completely unexpected and unpredictable tremors in the financial and credit markets all around the world if the dollar went negative. So they're not going to do that. They're keeping rates as close to zero as possible, but just above zero. And so they'll buy and buy and buy and buy bonds as much as they can all across the board to push the price of bonds up, which keeps the yields low, and they pull back the buying anytime yields get too close to zero because they don't want to pass into the negative territory. So what does this mean for you? This means that when you buy a bond, your upwards potential in terms of appreciation in the price of the bond is capped. It's not going higher than the actual value of the bond because the Federal Reserve is virtually the only buyer of all credit right now. They're buying corporate bonds, they're buying muni bonds, they're buying junk bonds, they're buying treasuries. They're the ones who are buying up all of the debt on the market right now, and there's a cap. They're not allowing rates to go negative. They're purchasing these bonds up until they're at their max, and as soon as they hit their max where it would tip the scales to make that interest rate go negative, they stop the buying and let the market forces kind of sell that off to let those rates go back a little bit more positive. So when you buy a bond, you're capped in terms of your upside in terms of price appreciation. You're not going much higher there. And you say, okay, well, most people don't buy bonds for price appreciation. You buy stocks for price appreciation. You buy bonds, though, for yield. You buy bonds for the safe interest. What interest? Yields are zero. You're locking up your money for 10 years for 0.5%? There's no income in that. If you can honestly tell me with a straight face that you think the cost of living, inflation, price inflation, is going to be below 1% for 5 years, 10 years, 20 years, then you deserve to own bonds and get destroyed by inflation. But there's absolutely no possible way in any way you look at it that the cost of living is not going to outpace that. That means as you get your interest and principal back, you are losing money in terms of real purchasing power. The yield is not high enough on any bonds anywhere right now to pay you back, even to help you keep up with the rate at which cost of living is increasing by. That means that you are actually losing money. Your wealth, your purchasing power is being destroyed just by relying on interest rates when you invest in bonds. So you have no upside from price appreciation. You're not preserving your purchasing power. You're slowly killing your purchasing power. And the biggest whammy, you're exposing yourself to massive risk. Because you can only manipulate free markets and keep them where you want them, artificially manipulate the prices and the yields of markets for so long until something snaps and something breaks. And that is exactly what's going to happen with the bond market. Probably not treasuries. If you invest in treasuries, you're gonna get your principal back and you're gonna get your interest back. It's just not gonna buy as much for you as it buys today. But investing in other bonds right now, you're exposing yourself to massive risk of huge sell-offs in those bonds. And you better hope you don't need liquidity at the exact moment that everybody else in the world is so desperately in need of liquidity that they're selling off their bonds as well. Because if you have to sell off your bonds at that point, you're taking a 10, 20, 30, 40, 50% loss on a bond. And I guarantee you, once the free market and once most of the economy realizes how bad inflation is going to get and how fast the purchasing power of money is deteriorating by, nobody who can set their own interest rates is going to be happy with accepting 1 or 2%. Yields are going to skyrocket. If I'm going to loan you money, I'm going to demand a much higher interest rate, or else it's not worth it. And as we learned at the beginning, when yields skyrocket, prices of existing debt plummet. So that's your public service announcement. That's my PSA for today. Bonds have limited upside, limited to no upside really, and they have massive downside risk. And even without that massive downside risk being realized, you're just slowly watching your purchasing power drift away. Thank you so much for watching. If you enjoyed the video, please hit that like and the subscribe button if you haven't already. And let me know your thoughts, questions in the comments section below. You guys are the best. Have a great day.